Hey, this is George with Royal Metals Group, and I wanted to give you the cliff notes for an interview with Marc Faber about quantitative easing number 2. Anything under $1 trillion will disappoint this market. They've already factored in quantitative easing. Marc expects continual weakness in the dollar, and of course, he's strong on gold, silver, and commodities. In the near term, Marc is expecting a correction, but by Christmas, a boom in stocks and commodities. Marc is reasonably positive on equities because of the inflation plays, but of course he's negative on cash and bonds. Regarding China, we will see an economic pullback. Their economy is overheated. We're seeing living expenses exceeding 15% and food going through the roof.
Marc Faber is here in studio with me, the editor and publisher of the Gloom, Boom, and Doom report. And, Marc, you called the 87 crash. When you're looking at what's happening right now, I know you're very critical of what's happening down in Washington in terms of the Fed chairman and in terms of this administration's intervention in the economy here. Does any of that change November the 3rd with the midterm elections?
Well, I don't think so, but I think QE2 will be interesting to watch.
The other thing that happens possibly November 3rd?
Yes, exactly, because basically what we have is back in July, August, investors were very bearish on the market, and they talked about the Hindenburg omen and that everything would crash and so forth. And what then happened is that September was very strong and October was a reasonably good month as well. And the market has gone from a low on July 1st of 1,010 on the S&P to close to 1,200. And so a lot of QE2 has been discounted. And if you were Mr. Bernanke, I suppose that you would probably disappoint investors somewhat with QE2 and watch once the market reaction. If the markets really sell off, you can then increase QE2 or launch QE3, and QE4 and QE5 and so forth. There'll be many more QEs.
So are you saying regardless the market's going to be disappointed with QE2, or does it matter the size of the kind of either shock and awe or piecemeal campaign?
Well, I think that anything under $1 trillion will kind of disappoint the market a little bit, and then the markets are stretched. We are in the inflation trade again. Weak dollar, strong precious metal prices, and strong equity prices, especially in emerging economies and now also frontier markets, and strong industrial commodities. So I think that a correction is overdue, but I wouldn't think that the bear market is around the corner. I think on a correction there will be a buying opportunity, and maybe we'll have a crack-up boom in stocks and in commodities like between the end of 99 and March 2000 when the markets went up very strongly.
It sounds like that trigger for that correction, as you call it, is QE2. That's what you're predicting.
Yes, and I mean the elections, who knows, but I think the Democrats have, sadly enough, another shot at keeping the majority.
So it doesn't sound like you're getting any more optimistic about the outlook for equities in the US.
I'm reasonably positive about equities. I think equities are more attractive than bonds and cash in the long run. Say if you invested for the next 10 years, you shouldn't be in cash and US government bonds. You should be in equities, and then you would have to choose, obviously, equities in the US or equities in emerging economies.
But you're still avoiding financials, autos, airplanes. You like Microsoft.
Well, I mean, I've been kind of interested in some high-tech stocks for quite some time. And some have done okay and some haven't done all that well. But my major recommendations in the last few months were actually agricultural commodities. And I continue to recommend the accumulation of precious metals, whereby I think they are overdue for some kind of a correction here. And then we'll get the next move probably next year and thereafter.
Well, we've been seeing that inflation trade you're talking about there. If you're also forecasting more of a weaker dollar, when do you see that inflection point to come in some of those commodities?
Well, as I said, I think the dollar is very oversold, and some of the foreign currencies like the Japanese yen and the Swiss franc are overbought. And so we could be at very close to an inflection point where the dollar rallies for a while and where asset markets come off. Don't forget, back in June, everybody was very, very bearish about the euro. When the euro touched 120 against the US dollar, people said it will go to parity. Instead, the euro has turned around and went from 120 to 140. And now everybody is very bearish on the dollar and very bullish on foreign currencies. I think it's a very recognized trade. And I would be a little bit careful to just blindly short the dollar and to go long assets at the present time.
All right. Welcome back to In Business. We're continuing our conversation with Marc Faber. He's the editor and publisher of the Gloom, Boom, and Doom report. And Marc, when it comes to China, you were predicting maybe not doom, but certainly a pullback. When you were last on Bloomberg, you were looking for a real strong pullback in the Chinese marketplace. Do you still foresee that?
In the economy, yes.
In the economy.
I mean, I think that the economy has many imbalances, and some sectors are overheated, and you have, like in the US, artificially low interest rates that then lead to very strong credit growth and monetary expansion.
So even that increase by a quarter point of the deposit and lending rate, you don't see is changing it?
Meaningless.
Meaningless to you?
Because the property prices are going up so much, and the cost of living are going much more than what the government is publishing. Say, the typical rate of inflation in China, India, Vietnam, for the majority of people, has to be around, say, between 8% per annum and 15% per annum, because in economies where you have a low GDP per capita, food accounts for, say, 50% of your expenditures, and food prices have been going up a lot.
Mm-hmm. You point out, because much of the conversation that's happening in this country about China is focused so much on the currency, and you say even if yuan doubled, we'd still have a trade imbalance there.
Well, the problem for an emerging economy like China, or the others in Asia for that matter as well, and in the case of Thailand, on a per capita basis, Thailand has larger foreign exchange reserves than China. The problem is really this: you have these huge liquidity inflows through trade surpluses, current account surpluses, and also through capital flows. So the country in question, say Thailand or China, what do? They can let the currency appreciate meaningfully, or they can let the asset prices in the country appreciate meaningfully, or a bit of both. The problem with a bit of both is that once the speculators see that the currency is appreciating, they pile even more, and the currency is pushed up to unrealistic levels. And then one day the capital flows out.
I've got to leave it there. Unfortunately, we have to take a break here.
No
Marc,
problem.
thank you for being with us.